We've heard a lot on this program about the macro risks that threaten to crash today's markets, but nobody knows for sure what's going to happen. So, what do the bulls think? We asked Silicon Valley hedge funder Glen Kacher to share the reasons why he thinks stocks still have a bright future ahead. To learn what they are, keep watching this video. As always, please take a second and click on the like button to help us continue the run of amazing guest experts like last week's Jim Rogers that we've been having on this program. The more likes these videos get, the more big names we're able to attract. And now, let's get started watching this week's market update featuring Glen Kacher. Hi folks, Adam Taggart, co-founder of Peak Prosperity here, welcoming you back to another week of making sense of these markets. And look, today's guest is a special guest. It's one of our audience response guests. Many of you have been asking for somebody who is not a dyed-in-the-wool bear, somebody who can come on and make some of the arguments for why maybe there is reason to be optimistic, even bullish, for parts of the market, parts of the economy. So today we're very lucky to be joined by Glen Kacher. Glen is the Chief Investment Officer and founder of Light Street Capital. It's a hedge fund, and prior to founding Light Street, Glen worked for over a decade as a managing director at the venture firm Integral Capital Partners, which is a very storied firm in the Silicon Valley area. Before that, he started his career as a research analyst at Julian Robertson's Tiger Management hedge fund, which is famous for spawning a bunch of tiger cubs like Glen, folks that went out and successfully founded their own firms after working there. So we're very lucky to have a guy who is a very seasoned, experienced investor. Most of his investments, I'll let him explain, but tend to be long the market, long elements of the market. So anyways, I asked him in response to many viewer requests to step into the role of an expert who is more towards the bullish side of the spectrum than the typical guest that we have on this program. Many of you have been asking for somebody to share that type of perspective. So we're delivering on that today, and I'm really grateful for Glen for having the courage and willingness to strap into that seat. In the spirit of full disclosure, Glen is a friend. He and I know each other back from our days at Stanford Business School. And even more important than that, his wife introduced me to mine. In fact, Glen, I think that happened before your wife even had met you. So anyways, we've got lots and lots of points of commonality, but most importantly, I just appreciate you coming on here with us today. Thanks so much.
Thank you very much, Adam. I appreciate being here.
Great, thanks. And as always, we're joined by the lead partners of New Harbor Financial, the financial advisory firm that's officially endorsed by Peak Prosperity. That's John Lodra and Mike Preston. And after we talk with Glen, I'll be talking with John and Mike about what's happened in the markets since we met last week. Thanks for joining us again, John and Mike.
Good to be here, Adam, and nice to meet you, Glen.
Oh, good to be here.
All right, so Glen, let's just roll up our sleeves and jump right into it. As I like to start each of these programs off, without introducing any of my biases here or the biases of Peak Prosperity or our viewership, just honest answer. What is your assessment of the state of today's economy and financial markets?
I'll do my best, Adam. I don't view myself as a macroeconomist or a macro investor. We actually think of ourselves really as fundamental investors that are really focused. Our fund is often put into a group of funds called TMT funds, for tech, media, telecom. So we're focused on those sectors, and the technology industry's grown in lots of different ways, and software technology has grown into many different businesses. So that defining the edges of that universe is sometimes hard. But I think that I'm an investor in one of the best industries in the world, certainly over the last 20, 25 years. And I think a lot of people would agree with that. So I'm investing in what I think is a really successful part of the economy in a larger equity market, as you point out. And just to level set a hair, our hedge fund and a lot of hedge funds, not all, but on the equity side, tend to be positioned with maybe 2 to 1 exposure. So $2 of long exposure for every $1 of short exposure. So understand, I'm always betting for the market and against the market at the same time. So to get to your question, look, I think we've been in a low interest rate environment, a relatively high growth economy, not screaming growth economy over the last 4 years since the Trump administration took over, and a low to no inflation economy. So, and we could talk about that, but I think that the dominance of technology or the influence of technology over the last 20 years and the internet itself is probably the most disinflationary force that we've ever seen. And Adam referenced us knowing each other for a long time. I can remember Adam at one of his early jobs in the early days of the internet at My Simon, where it was one of the first price comparison engines. And literally for the consumer, it helped you find the absolute lowest price possible to buy an item on the internet. It was amazing. And that was 20 years ago technology. So we have this economy that is, for all intents and purposes, doing very well. There is this issue. There are issues, as there are in all economies, and economies are very large things, and stock markets are very large, enormous entities with many variables going into them. I mean, we do have this problem with the disparity of wealth, that and technology is an industry that lends itself to being winner take all, and that leads to a few winners and a lot of losers. And so there are underlying issues, and there's a lot of people that have tapped out of the workforce, as and the today's unemployment statistics don't capture, or historic unemployment statistics don't capture that. So you balance all these things out, and you of course have a government that's running fairly large deficits, which is yellow or worse color risk factor. And so that's kind of how we think about it. And then you've had this year the shock of COVID, which has been I think incredibly positive for the tech industry. We can go down that road if you want to, and not so positive for a lot of other verticals. But if I weigh out everything, and I'm cautiously bullish, I'd say. And as I said, it's not really my career path to speculate on the direction of markets, but I'm cautiously bullish on the economy continuing on this growth path, assuming that whichever president, the election hangs in the balance as we speak, whichever president ends up leading the country and putting budgets to Congress, though that will be a very important input factor on our economy going forward. And so tax rates particularly, we are worried, we are concerned about rising taxes under a democratically dominated government. So and so that's a risk factor if Biden does go on to win this election. I think the market is right at this second looking at the unexpected strength in the Senate races and viewing that as a gridlock scenario. Even if Biden does, as he looks like, win the election, a gridlock government is good for financial markets, as we all know, I think. And so that I think is bolstering the bullish fever, particularly this week. So I tried to run through a lot there. I apologize for the length of my answer, but it is a very complex set of questions.
No, you did a great job. And again, a lot of the questions I'm going to ask you are macro in nature, and I'm not necessarily expecting you to be the macro expert to kind of have the answer. But knowing sort of as a fund manager, what decisions you're making based upon your own interpretation of the macro scenario is really useful for people to understand. So a couple of things. First and foremost, thanks for the shout out about my Simon. I think you're probably the only other person on the planet that remembers that brand, but I'm impressed that you're able to pull that one out of your recesses there. So a couple of things. I guess first, let me just respond to your point about what the markets are doing this second. I mean, it's kind of crazy. I saw kind of a matrix that was put together in parity prior to election day, which said, okay, here are all the different outcomes that could happen with Congress and who wins as president. And within each box of the matrix, it was basically stocks go up, right? We had literally, the beginning of election day, Trump's doing great. All right, it looks like a Trump victory is going to happen. So futures, took off. And then it looked like Biden was going to win, and stocks wavered, and then they started to take off because, oh great, the Trump story is okay. Status quo continues. That's great. We've gotten rid of uncertainty. A Biden win is blue wave election. Okay, great. Biden's going to be able to get all this stuff through. We're going to have tons of stimulus coming through. And then now it's, oh, wait a minute, it's going to be, a divided Congress and maybe just a barely Biden win. And so that's gridlock, and that's great for everybody. Like, it is silly in some ways that no matter how the dice rolled, the market is taking that as an opportunity to just continue to go up higher. But I don't want to get rat holed in that.
Hold on, I think that's an important point you're making. I think in a world with low interest rates, everything looks very rosy. Mm-hmm. There's free money about to speculate with, and people can borrow money and spend it aggressively, and when their credit card statement comes at the end of the month, they can kind of look at it with a squinty eye and not really look at the balance that carefully. And that gets harder to do as interest rates go up. And so I think that is a sign of the times. I mean, personally, I was very, as a hedge fund manager, you write a quarterly letter to your investors. I wrote a quarterly letter that addressed the blue wave and Biden victory scenario as being, because I saw it as the most probable scenario based on polls. And I got in some of my investors didn't like my analysis of that because it wasn't as positive as you're mentioning. But we'll see. I mean, as I said, I'm not a macroeconomist, but I do my best to lean one way or the other.
All right. So you talked there about low interest rates, and that's sort of the territory I want to get into next, which has sort of been the role of the central banks and the Fed in terms of the investing environment that you've had for the past decade or so, right? So you've had really historic low interest rates and a lot of money pumped into the markets over the past decade, but particularly this year, right? And Jerome Powell, is the latest string of Fed chairs to say, look, I'm here to do whatever it's going to take, right? So, on the one hand, at least lots of our viewers, would say, okay, look, we've got big concerns of an asset price bubble, perhaps even bigger than the two others we've seen in recent lifetime, right? .com bubble, 2008 bubble. One, I'd be curious your thoughts on any of that. And then as an investor, do you, or manager of capital, do you basically just look at that as almost sort of like the Chuck Prinz, like, look, while they're playing the music, we got to get up and dance, and we'll dance until it looks like it's going to change, and then then and only then will we try to maybe sprint for the door.
Yeah, great questions. Globally, there's been a race to the bottom on currency values and therefore interest rates in a central banker attempt to boost exports in the global trade game, and that game has been played for a long time, and arguably has been played to I don't want to say a conclusion, but at least a point where interest rates can't go much lower unless you go negative, and negative interest rates are I think quite confusing. for the impacts that it has on the economy, and throwing all the economic or inverting, some economic rules is not an experiment I want to live through. So I think I think, we're at the, we're sort of in that zip code where, we can't continue to play that same game, nor can, all the other central banks around the world. So, and as you point out, one of the side effect of that is it's very, this kind of interest rate environment is great for financial assets. So yeah, our job's to take advantage of that. It's a great backdrop. It's been a great backdrop for us. What does it mean now? And how do the central banks around the world get out of, this trend, or how do they, boost their economies in a without having that lever to continue to pull? It's a great question. I mean, we're known as a relatively global investor in our sector. And typically we have, 40-ish% of our 40 to 50% of our exposure is out of the US. In the last couple of years, that is, at the low end of that range. And I'm lucky in that I'm in an industry that has terrific prospects. So I'm still able to find some terrific foreign or international investment opportunities. So, we will continue to play, but whenever we feel like that there's a macro problem occurring, or some sort of shock in the market, we do adjust our gross exposure, so total dollars bet, and our net exposure, our longs minus our shorts. And for instance, in the spring, we did pull our exposure down pretty dramatically, going into the COVID crisis, let's call it, and ultimate shutdowns, until we figured out what those things meant for our industry. And at that point, we realized that, wow, the positive impact of COVID, or the way that our economy was going to deal with COVID, was very beneficial for e-commerce, for electronic payments, for cloud computing. And so we got, as an industry, lucky that our already well-positioned industry got new tailwinds through this period. And what I like to say is that the companies that avail themselves of digital technology are the ones that do it most aggressively in their sector have done the best in terms of fundamentals and stock price performance.
All right. So I want to dig into that for a bit. So you talk about, tech has been a big driver of the economy, over the past couple of decades. And you talked about how it's, almost kind of having this additional tailwind given what COVID threw into the mix here. So totally understand that part of the bullish story. Some other questions though. One is, and we saw this pre-COVID, tech has been on a tear, and it was on a tear pre-COVID. And you've seen companies, let's take Apple, right? Great example. Super successful company. Stock has performed very well, but revenue growth has actually slowed, right? I mean, even same thing with Tesla. The revenue growth in Tesla, even pre-COVID, wasn't stellar, right? But these companies have seen really huge gains in their stock prices. And again, a lot of that started pre-COVID. And of course, they've rebounded crazily since COVID. So I guess my point is a lot of the value in these companies has resulted in multiple expansion, right? At what point do you worry about valuation, right? That, hey, these are companies that have good prospects. but the prices are just getting way out in front of what the actual fundamentals deserve.
Yeah, I mean, we worry about it every day, frankly. I mean, every single position we have in our portfolio, we underwrite, individually and say, okay, what's the multiple today? What do we think the multiple is going to be in 2 to 3 years? And then we also are projecting fundamentals and saying, okay, therefore, here's where we think the stock could be across a number of scenarios. Good, better, best kind of, or risk reward base case, either way you want to say it. And we're doing that on longs and shorts. So we take into account multiples and are very cognizant of where they are. I think you have two great examples there, and that get into how the stock market works and how it is working today in our environment. So let me take them because they're really good ones. Apple, for instance, I totally agree with you. I mean, last year was largely a mediocre year for them. They had the iPhone 11 turned out to be, I think, a little better, better than expected, but it was pretty modest growth. And if you look under the covers with the iPhone 11, the outperformance came from the fact that the average selling price of the phone was much higher. It wasn't by any means a blowout on units. It was just people realizing, hey, I use my phone all the time. I used to pay $2,500 for a laptop, or even more for a top-notch business laptop. And now here's this device I'm using all day long for personal and business, and to do everything in my life. It's $1,000, and for some people, they're willing to continue to march those prices up. And so it benefits from that. I think the thing that the bull case for Apple has been, and we don't own Apple, but the bull case is that the services business, which is recurring, which in theory deserves a much higher multiple, although it's lower margin than their very expensive hardware business, or selling expensive hardware products. So the investor community has viewed that as a very positive thing, having a higher and higher percentage of their revenues be recurring, as opposed to episodic every other year, let's say, roughly on average, people upgrading to the new iPhone. So that's kind of what's happened. Now, the defensible argument with Apple is that here's a company that a few years ago was trading at a low to mid-teens earnings multiple, and it was growing at a very high rate, right? And so, a lot of investors, myself included, said, it's a hardware business here. These are kind of where the multiples tend to be. I think what's happened over the last couple of years, and especially with low interest rates, people look at stocks that historically have been owned as bond replacements, like P&G or Heinz, or any of the other famous CPG companies, and those companies routinely grow in the mid single digits range, earnings and revenue, and they've traded at high teens to low 20s earnings multiples. And Apple, which was growing at much higher rates, but had this problem that their business was more episodic or hits driven, it was trading at a multiple that was maybe 2/3 of that level. And so I think that as the world's economy has gotten more dependent on technology and more consumers are comfortable with technology, the multiple has been bid up dramatically at Apple in a period where they're fighting mightily with the law of large numbers and the ability to grow fast. Tesla, I'll just spend a second on that. That's quite a different story in terms of, I think why it's gone, why what has happened. But you have a company that's, a couple less than 2% of its end market of cars, broadly defined, and they are the only truly successful maker of electric cars, and they were moving into the Model 3 and the Model Y over the past couple of years, with the 3 being a well-executed sedan, but arguably the sedan portion of the auto market is not the most exciting portion. And they were moving into, with the Model Y, the most exciting, fastest growing portion in terms of mid-sized SUVs. And of course, promoting future moves into semi trucks, as well as pickup trucks, another massive profit pool. And so that's an example of investors that are willing to look forward several years into the future, making a big long-term, perhaps more speculative bet than anyone is used to being made in the auto industry, and it resulted in a explosion of equity value, let's call it. So that's kind of where that's my best attempt at answering those two specific questions.
Thanks. That was a polite way with Tesla of saying that stock's kind of a speculative party, but I think you said it very judiciously. Hey, real quick, we're running out of time because I told you this would only be about 15 minutes max, and we've blown way over. So thank you for giving us the time. This is actually really helpful insight into how, sort of the traditional, more alongside investor thinks. So thank you for that, Glenn. Since we're talking about tech, you talked about it sort of being a winner take all industry, and there's all different types of tech, right? So I don't want to just, pretend this is the only kind. But the FANG stocks, the FANG complex has certainly, hoovered up a ton of its share of the market. It's certainly been the darling sector for, honestly, way longer than I thought it could have been, this dominant. But the point I'm trying to get to is, I have said for years, some of these companies, I don't understand why they're not classified as either monopolies or at least in violation of important parts of antitrust law. And we're beginning to finally see, Congress wake up to that. So I'm just curious, your short thoughts on that, both in terms of how real is that risk, and what do you think the implications for Congress's current scrutiny might be?
Yeah, they're certainly very valuable companies, right? And I think that the amazing aspect of the internet basically being a worldwide distribution platform with very little to no marginal cost to reaching new customers has driven incredible equity value during this period. So I look at I come out on the other side. If you and I'm not an antitrust expert, but I do my best to interpret what I read, and the long-term way that we judge monopoly power and abuse thereof is around what do companies do with that power? Do they raise prices and take advantage of consumers? And I think that the way that that antitrust and monopoly power is interpreted and enforced today does not really apply to these companies. I think if you look at what, for instance, Amazon, just to probably the easiest one to talk through, does is, they dealt with early on price comparison engines, like as My Simon was, and that they came and say, okay, we have to compete. We're going to have a really low price. It may or may not be the lowest, but we're going to compete on any other metric that we see as being important. So availability, speed of getting your product, the low price of fulfillment, the efficiency of their fulfillment versus others. And they came to the conclusion that in order to do that best, they had to be by far the largest. And they had to push off making any profit for many, many years. And the way that we do accounting in the GAAP system, which is the leading accounting system in the world, is that you can capitalize certain expenses and of course expense others. We don't. E-commerce as an industry is not well served by the way GAAP works, because it's effectively in some ways like a loose subscription business. You're paying a lot of money to acquire a customer up front. You can't capitalize that cost and amortize it, or it isn't the proper convention. And you don't really own the customer anyway. You operate at their at their pleasure, effectively, or. So in any event, the way to be successful in this example with Amazon is to not make any money and drive your prices down for a very long period of time, and ultimately get there by being more efficient, and get to profitability and beyond, extreme more profitable, let's say, and then enter new markets like AWS. And Amazon has run that playbook amazingly. But I think if you define the market, and this is back to how we look at antitrust laws and monopoly laws, if you define the market as being all goods sold, not just goods sold online, and I think with big successful companies like Walmart and Target and seemingly every offline retailer that wants to survive entering e-commerce, it's hard to argue that it isn't the same market. And so for that reason, as the way the market is defined, these companies are going to escape most of antitrust law. Now, they can do things that are anti-competitive in small places, and they can get caught for that, and they will. So I'm not saying they're angels and they do everything right. They do have 500,000 employees at Amazon, for instance. So, and a lot of them are in fulfillment, but there are a lot of them in the e-commerce portion of the business. So it's hard to control what your employees do and say over time. But when you have a business that large, so I don't really see the government being a major problem or impediment to the success of today's very large successful tech companies, for the reasons that I mentioned here.
All right. Well, thanks. And it's frustrating in the sense that any one of these questions I asked you, I feel like we could have a hour discussion on just that topic alone. So I'm going to have to skip off this. But Glenn, if you've enjoyed this and our audience is enjoying hearing the alternate point of view, would love to have you on again at some point in the future. Couple quick questions as we wrap up here and we let you go. And you can give me the 15-second answer on these things. Don't feel a lot of pressure to have to go long. What would be sort of your general, I don't want to say advice, but just sort of general, feedback to the average viewer in our audience who has the concerns I've mentioned and has been sitting kind of on the sidelines because they've been very cautious of the markets. Looking forward ahead, as you see, let's assume a Biden win, let's assume, at least for the foreseeable future till the next election cycle, a divided Congress. What would be your general kind of counsel to the average investor that I described?
Yeah, I mean, I hate to sound like a lot of other, much more famous and successful investors, but I do think for the average customer, and I look at myself and look back over the last 20 years. A few of the best investments I've made in my life have been, to buy, whether it's an individual stock or it's a ETF that is backing a particular part of the economy that you can look out and say, gosh, this is really this is a long-term favorable business. And so I early on, bought some shares of Google, bought some shares of Chipotle, bought some shares of in the QQQ, the Nasdaq, and just kind of put them away in my retirement accounts, and it's amazing sometimes the less activity that trading activity, the more successful you are.
That old saw, the more you touch it, the worse it does, right?
Perhaps, yes. And it's very hard. I mean, in my day job, we're an active manager. We are definitely making adjustments to our portfolio. So it's interesting just to kind of look at things that I've done 10, 15, 20 years ago and realizing, wow, that was one of the most amazing investments I've ever made.
All right. Yeah. So if I could shorten that a bit, it would be, don't be afraid to be long something, even if you're conservative, don't be 100% out. And I'm putting words in your mouth, so correct me if I'm wrong here, but I see it kind of nodding.
Yeah, no. And look, I look at our industry, and just to kind of throw one thing out there, we've had this incredible run in what we would call electronic technology, all the computers, semiconductors, internet, in that universe. I mean, when I look out over the next 20 years, what's happening, if I were to restart my career, I would be very, very tempted to be looking at the genomics sector and that part of the biotech and diagnostics universe in healthcare. I look at that, if I look at across all the major S&P sectors of the stock market, I certainly wouldn't be, growing up wanting to be an expert on the oil and gas industry now. And I think the financial industry is difficult as well with the interest rates where they are. But technology still see incredible opportunities, and genomics, that intersection between technology and healthcare, and DNA, and the science to create drugs and to look for disease. There's amazing things occurring there, and I think that's a 20+ year, probably much longer than that cycle. That is, it's already real. It's not like it's nascent, but it's probably the next great mega cycle.
Okay. Well, geez. Well, thanks for sharing that. So we took on a tremendous amount of new viewers on our YouTube channel earlier this year due to our coverage of COVID. And if you're comfortable just giving us the quick 30 seconds, I know that I think you've actually had it, Glenn.
Yeah.
How was it? How was your experience?
Well, it was scary, frankly. I contracted it. As soon as I had a few symptoms, I quarantined myself in my house, and was successful in the fact that it didn't spread to anyone else in my family. And so we got lucky, and I got lucky. I had very mild symptoms. A headache, a fever a very light fever for 36 hours, 99 degrees, and some, stuffy nose. But it's I think it's very real. After having it, you really can understand how certain people might come through this and say, wow, there's nothing. It just sort of happened. No problem. This is a hoax. And I think that for most people, luckily, that is the case. But for that narrow minority, it's obviously incredibly serious. And for that reason, I had to be super careful about interactions with my own family members, extended family that are in the older ages. And so happy to get through all this, and it was relatively easy, but at the same time scary.
All right. Well, yeah, knocking on wood here. Glad it went well for you. And anyone who's been watching our channel knows that we've spent tons of time talking about exactly all the risks that you just alluded to there. And we've certainly heard tons of stories from people in our audience who have had family members who didn't have as good of a time as you did, Glenn. So I'm glad that yours was one of the more mild cases. All right. The last question as we part here, for folks that have enjoyed this and would like to learn more about you and your work, Glenn, is there any place they can go?
Well, we've had some press over time by some popular, institutional investors written some articles about us. Fortune has written an article or two. And I occasionally appear on CNBC on a couple shows there. So you can see, you can read there. I mean, I think the best place to follow any professional money manager that has more than $150 million of U.S. assets, reportable assets, is to follow their 13Fs and see what they own. They're lagged by 45 days, but 45 days after the end of every quarter, you can see what longs a fund owns, and that's really the best way to follow any fund.
Great. And so for folks that maybe weren't familiar with a 13F, it's a document that funds like the size that Glenn mentioned, they have to publish what their major holdings are. Glenn, they can probably just go to a Yahoo Finance or whatnot. Or I guess for a private, can they do it there?
Yahoo Finance. The easiest thing is just type in the fund's name and into Google and the results should show up as that fund's there you could go to the SEC site and find it there, but it gets syndicated across many different publications.
So just type Light Street Capital 13F into Google and see what comes up. Great. All right, Glenn. Well, look, thank you so much for giving so much of your time. Again, really glad you came out on the safe side of COVID. And hopefully we can have you on again at some point in the future if your schedule allows. And please give my best to the family.
Thank you. And I appreciate the great questions.
Thanks. All right. Well, look, John and Mike, great experience, definitely very different from our usual fare. It's been excellent to hear, somebody from, the long side of the story and really helpful just to kind of crawl in their head and see how they look at the world and see the decisions that they need to make. That went a little bit longer than I thought, so we'll keep this relatively quick here today. But I guess first question, we'll start with you, John. Any general reaction to what you heard from Glenn?
I think a lot. I think what he said was right on. I mean, he's was very clear that his fund and his focus is not macro. We tend to be more macro and looking across broad sectors and the broad investment landscape. His focus is decidedly more tech-centric, and that's been a consistently growing sector of the economy, and his style of bottom-up research there is especially important, and especially could be value adding when you get to broad overvaluations of markets like we have right now. That's where picking individual stocks and shorting individual stocks for a firm that has that kind of pedigree can be value added. So it's refreshing to hear his input there. Sometimes we're envious of folks who can look at a narrow sector of markets and we could never invest our clients like solely in technology.
100% in any sector. Yeah, exactly. And it's interesting. So, I know Glenn and I also, came from that area, right? I mean, was in Silicon Valley for, over a decade, 15 years or so before moving up here to the apples, the apple orchards. To a certain extent, that person, is self-selecting, right? They've got a certain DNA, they're more risk-seeking, they are more of a believer in the promise of not just technology, but sort of the status quo. So you have to take all that with a grain of salt, just as you have to take everything we say with a grain of salt, given the perspective that we're coming from. I think it is important for those of us that do have a different opinion and are much more concerned about the macro risks than Glenn perhaps might be. You have to say, okay, look, well, to a certain extent, Glenn's approach has been winning, right? I mean, that especially the tech sector, but the markets in general have done great, right? And of course, those of us who are much more cautious are like, yeah, but I've seen this story before, right? People just fall in love with the excessive euphoria, and they begin to think of it as normal, and that makes you vulnerable to a rug pull when an overextended system collapses, right? So I just want to be real clear with our viewers. Peak Prosperity's perspective hasn't changed. I'll let you, John and Mike, say whatever you want to say from the New Harbor perspective, but I assume it's the same. But it is really important, to understand what the other side is thinking, and also too to be honest in calling the shots. That they've enjoyed a great tailwind, and geez, if you jumped into tech the past 10 years, you've done great, and if you jumped into it at the nadir of the March lows, you've done unbelievably well. But again, personally, as we've talked about on many past episodes with many past experts, we think a lot of that is engineered and not sustainable. So switching gears, Mike, let's get to you and just talk about sort of what's happened in the market since last week. Of course, the biggest thing that's happened in the world is we've had an election, one that is still unfolding. Glenn and I talked a little bit about what that's meant for markets, and I'll let you give the details. But I mean, one stat I just saw today is I think that the tech sector, the FANG complex, has had its best 3-day period since 2015. Who would have guessed that, without us knowing the official results of the election yet, that has been a green light to the markets to that extent. But anyways, what have you been seeing from your perch, Mike?
Yeah, this week it's just been a locomotive one way, hasn't it? Like you said, the best 3 days for the FANG complex in 5 years. It's really hard to keep in mind the big picture. The market's still 18 or 19% above the January 2018 highs, going on 3 years. Everything and then some has been thrown at this market every single time it's tried to correct. We stand at the highest valuation level really in U.S. history, the way that we think it should be measured. If you look at the 10-year Schiller price earnings ratio, it's 33, 34, something like that. If you adjust for profit margins, it's in the 40s. On a price to earnings ratio, stock market capitalization divided by GDP is at 170%. That's even with the bounce in GDP growth. It's an insanely overvalued market. All of these stories about tech and growth, and it's all well and good, and all this talk about stimulus, but they're all just kind of buzzwords. We look at the actual data, and yeah, we're envious when maybe we didn't jump in as much as, like you said, you could. Some did back in the March decline. Sure, we wish we jumped in bigger. We did jump in a couple slices and added some exposure. But yeah, those that kind of went blindly in have done really well on this bounce. But as John said, we really can't do that for the bulk of our clients' assets, because we do take a macro view, and for most people, we do manage the majority of their household assets. But kind of just getting down to the numbers, this week the market's up 250 S&P points, let's say, roughly, as of right now. Last week it was down 200 points. So clearly the market sold off in anticipation of something, and I don't know what was expected to happen, but it does seem like no matter what happened, the market wanted to go up. And so we went up a little bit more than we went down last week. And so the market is clearly liking whatever is happening. Maybe it's just the fact that it's that the uncertainty is behind us. But volatility had dropped markedly this week. The VIX went from 37 to 27, but still volatility, or VIX up at 27, is pretty elevated. So we are still extremely cautious, and as boring as it sounds, and as hard as it is to keep saying, that's where we're at. We're still very heavily in cash, waiting for better times to invest. Our most significant exposures to the equity markets are emerging market stocks and gold mining stocks. Emerging market stocks were just called out by another big firm in Boston that some people know. Name is GMO. They just wrote a piece about how they think emerging markets are a great opportunity. We agree, and we're in that space. And gold miners went from about 37 on the GDX to almost 41.5 today. So, and gold itself was up over $50 today. So everything is up. The market's up, the stocks are up, bonds are up, Bitcoin is up, gold is up, silver's up. Something's going to give at some point. So that's just a quick recap of a lot of different things. Sorry, I rambled a little bit.
No. Good recap. And again, I hate to cut this short, guys. We just had so much time with Glenn. But John, I want to more or less end with two charts that you sent over because they build on what Mike was just talking about there, which is that everything's up, everything's been going up. I asked the question directly of Glenn about his concern over multiple expansion, and he said, "Hey, that's something that we worry about every day, right?" So that's one of the, kind of the cracks in the veneer of the confidence of the bulls, right? Is they're sort of like, yeah, things are great, but if we really look at the numbers, gosh, things really do seem that they're pretty richly valued here. So I know you've got two charts there that basically show what tends to happen at periods of extreme overvaluation of the markets. Do you have one you want to start with?
Yeah, so there's one here, and actually it's drawn from some of the work that GMO, the Boston-based firm that Mike referenced, does, and they are long regarded for their work in cycles and valuations. And this particular chart, it's a long dated chart. It goes back to literally 1900, so 120 years. And basically, the gist of this chart is that there are decades, quote unquote, lost decades that happen more frequently than folks imagine, and we can define a lost decade of where a pretty traditional financial portfolio of, say, a 60-40 mix of stocks and bonds goes literally nowhere or even slightly negative over a decade. So when people think about stocks returning 10% a year, they better check their math in terms of what history says, anyways, because from the kind of valuations we're at right now, history would say we're ripe for a lost decade. In fact, the chart here that GMO put together, looks at valuations. In this case, they use the cyclically adjusted PE ratio, the CAPE that Mike referred to, and also interest rates. So there are times where either stocks are overvalued or richly valued, or bonds are richly valued, as both being harbingers for the very real potential of a lost decade. We have right now a rare event that really, the only time in history that it really happened in such a profound way was right around the year 1900, where both stocks and bonds are crazily overvalued relative to their own history. So the conceivability of a lost decade from here is not only possible, it's actually quite likely, almost probable. So that's the reality. And it always feels most unlikely a call when the rearview mirror shows exactly the opposite. So when we're talking about the tech market going nowhere up for the last decade, that's exactly the kind of environment that breeds the prospective decade to be a potentially lost one. So that's that one. And then one that's a little bit more kind of nuanced or diving down into some of the internals of the markets. There was a chart that was put out. I think Crest Capital put it together, and they do some great work as well. And it basically looked at periods where the NASDAQ is up sharply, being a tech-centric index, and compared it to periods in the same snapshot where the equal weighted S&P 500. So looking at the broad S&P 500 companies in an equal weighted fashion, basically went nowhere. And the kind of degree of outperformance of the tech-heavy NASDAQ to this equal-weighted S&P index, in I think yesterday the day was for, is the only other time in history where it was even remotely like that was literally the tippity top of the tech bubble in 2000. So we got all these kind of flashing red signals that seem to be clustering together, that tell us that, hey, we can celebrate, near-term moves, but don't lose sight of the bigger picture and what it means to the, kinds of returns that people need and expect over timeframes that matter for them. So bottom line is, we think, despite, kind of the fervor in the market of the last couple of days, it's every bit as important to be grounded in data and very cautious about future expectations.
All right. Well, very well said. All right. We're going to have to wrap it up there for time, folks. But John and Mike, looking forward to seeing you guys next week when we have a little bit more clarity on where things have shaken out with the election and seeing what the markets, what trajectory they're taking once things become even clearer. But before we do, just a couple quick things, folks. Again, if you want to see who we are lining up as guests in the future or want to give any feedback on this program, best way to do that is to follow me at Twitter at @MenloBear. Lastly, as always, if you have yet to do so, you can schedule a free consultation with John and Mike and the team at New Harbor. They offer a completely free portfolio audit that takes into account all the different types of risks that we're talking about here, and takes into account, non-risks. In other words, if there are sectors that you're interested in potentially investing in, and you want to bounce those ideas off of a seasoned financial advisor, that's what these are for. They're completely free. There's no commitments to work with John and Mike and their team. They do this strictly as a public service for Peak Prosperity listeners. If that's something that's of interest to you, just stick around to the end of the video here. We tell you how to do that. It's really super simple. And with that said, John and Mike, thanks so much for logging in another week here. And it's going to be interesting to see what happens when the dust finally settles. But whatever it is, we'll talk about it here next week. Take care, guys.
Thanks, Adam. We look forward to it. See you next week.
Yeah, Mike.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.